Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. What's up, guys? Welcome to another Market Radar podcast. We're doing this one a little bit early. Gamma is going on vacation this weekend, so we're recording this one on Thursday, August 25th. Pretty
Yeah,
unfortunate because we've got a big day tomorrow on Friday, which we're not going to be able to cover today because it hasn't happened yet. So let's look at the year-to-date performances so far. As of August 25th, the S&P is down 11.67%, NASDAQ down 19.42%, Russell down 12.16%, and the Dow down 8.3%. All of these are still bearish trend. ES did tap Momo. It was getting close, but that doesn't mean it's close to becoming bullish trend. It could break Momo, reverse, and it still would be bearish trend. But we are getting close. Our regime matrix now has us at a 59% combined chance of risk off with stagflation at 35.1%. We're seeing a pullback in stagflation and an increase in inflation. So who knows, maybe we'll get a nice little risk on pivot. But, the system might be just a little confused. Well, not confused, but this rally would definitely, this is a risk on rally. So this would definitely improve risk on odds. But that does not matter until it is a leading regime. So we're keeping a close eye on it, but if we get a reversal in the market, those risk on probabilities are going to completely diminish just as they were a couple of months ago. So let's take a look at the calendar for next year.
next week.
Monday, we've.
Next week.
Sorry, what was that?
I said next week, not next year, but
Oh, yeah. Yeah,
yeah.
next week. Definitely not next year. So, Monday, we've got no major market moving events. Tuesday, we've got Fed Barkin speaking. We've got Case Shiller Home Price Index, Consumer Confidence, Jolts, and Fed Williams speaking. Wednesday, we've got Mester speaking, ADP Employment Report, Chicago PMI, EIA Petroleum Status Report, and Bostic speaking. Thursday, we've got jobless claims, productivity and costs, PMI manufacturing final, ISM manufacturing index, construction spending, EIA natural gas report, Bostic speaking again, and the Fed balance sheet. Friday, we've got motor vehicle sales, employment situation, and factory orders. So let's look at what the market did so far this week. So today was an insane close on ES.
Yeah, we basically shot up in a straight line in the last hour of trading. What this is reminiscent of is a power hour ramp. That's what we saw. We saw ES pretty much take off from the midday range. It's been chopping around for pretty much the entire day, and then just power close. So that's something that is again reminiscent of a bullish market. That's not me saying we're in a bullish market, but those power closes are usually or they usually occur in bullish trends.
Mm-hmm. Well,
Something
it's definitely not out of the question that we blow past Momo. That's
right,
actually what we were expecting initially
right.
last week. We
Yeah,
did take on some positions at Momo, but we weren't ruling out a breakthrough Momo, judging
yeah,
by the momentum that we had.
yeah. I mean, the market was up in a straight line. I did figure we would see a little bit more juice up because a lot of people get trapped in a situation like this, and then squeeze higher. And then I thought we would see a more of a snap lower. Instead, we're getting the shorter rise, shorter snap, and potentially maybe a second shot at squeeze to squeeze people out of the shorts, or especially what you're really squeezing when this happens is you're squeezing the people who get short down here, right? They get short, or
Hmm.
they're short here, or they're short on any of these dips here, like
Yeah.
here,
They
here.
they finally think they're getting some mercy, but then
Yeah.
there's the secondary squeeze that comes through.
Yeah, and they end up just mentally throwing the towel in, and that's where that's after which it really shits the bed, and everyone's like, "Oh my god, I closed out my shorts, the market fell apart." Like, yeah, like
Yeah.
that typical situation is because people capitulate, and then the market shits the bed. Could the market rip through Momo, shift trends, go bullish trend? We go into a risk pivot, we're in risk on. That's possible, but again, we take the regime that's on the table, not the one that we want it to be. So it's currently risk off stagflation. So we're gonna have to trade it and manage it as such. Um,
Yeah. And it's a good lesson talking about the squeeze of people that shorted in the 38, 3900 area. That's why we keep saying no leverage. Like this is not the time to go hard in any position.
right.
We we took on some why am I blanking? SPXU?
Yeah, we took on SPXU, but we
Yeah,
took
we
that
took on
on right here.
SPXU at Momo, but
Yeah,
like relative to the portfolio, it's a small position. We're still at 50% cash.
right,
And that's the way you're supposed to be playing this because, there's no direction here. It's
right.
it's V shape. The
Uh,
market keeps going in a W.
yeah, and we've done this before, right? Where the market just ignites off the lows, right, and just rips and then shits the bed. So we're in a think of it like we're in a gray area right now where the market can chop around here, break trend, go bullish trend, and we get that accompanied with a regime flip. That won't be the sole factor of a regime flip, right? But like the regime flips and this goes bullish trend, things can turn around. Maybe we can get
Mhm.
a bull market going again, right? Maybe
And
the GD.
honestly, that I could totally see that judging by how many bears are out there right now.
I
Maybe
know.
the market did price in everything when it hit the lows and now it's pricing in the recovery already. Who knows?
I mean, the one thing we have working, or the Bears have working for them, is Jim Cramer came out either today or yesterday and said the June lows are the lows and they're gonna hold. So
Oh
that,
shit.
yeah, that may just fuck some shit up real quick. But I know that this is really interesting because I can see the verbiage on Twitter. Everyone's bearish, and we're bearish too for a reason. Obviously, everything that we've showed you so far pushes us to be bearish for a reason. We are not fundamentally bearish from inside ourselves and our thinking. We're bearish because our system is fundamentally bearish, not because we want to be bearish or we're like, oh my god, the world's gonna end. It's the system is telling us to be bearish, so obviously we're going to be bearish. And the benefit of all of this is the system can turn like a week or a month. It'll take more than a week, obviously, given the severity of where. You could just look at the Nasdaq and some of these things. They're still quite a bit away from Momo unless there's a monster squeeze. But regardless, what I'm trying to say is there could be a pivot here in the short term that a lot of people will not be able to see if it happens, and it can also not happen. But I'm saying the fact that if it were to happen, we would have to then be bullish because the model is fundamentally bullish now. The system
Yeah.
is fundamentally bullish, and that's our big advantage. We're not going to sit here and call a bear market rally into a risk on regime, because by the time the risk on regime comes, it's no longer a bear market rally. It's a new
That
cycle.
just means the market itself is pricing in bullishness. It's
Exactly,
it's no longer
exactly.
it's no longer pricing in a recession or whatever it may be.
Right, and that's something that it's very important. We had someone actually message us in the pit earlier today, and they were talking about how stagflation, what the experience of stagflation would have been like in your portfolio back in the '70s, late '70s, early '80s, and um, it was really hard to answer that question in such a direct manner because in 1970 you had many different factors. You didn't have such diversification avenues of like ETFs, factor exposure funds, and just other types of products that you could go out there like the individual stock base wasn't as liquid, right? And liquidity itself was much lower. You also didn't have certain components to track things like tips, certain bond indexes. They didn't exist back then. So it's very hard for you to look back and say, man, my portfolio would have done XYZ. And a lot of people get snagged up on this whole gold thing. They go back to late 70s and 80s, and that's their primary driver for gold. If you speak to someone that buys gold, they're going to tell you gold goes up in inflation and gold goes up with rate hikes, which are both
Hmm.
which have
Well, yeah,
both been
well, because
proved.
that's like the only evidence that
Right.
they've had
And
in the last 50 years.
fundamentally, since then, it's been actually proven incorrect, right? The Fed hiking interest rates fundamentally pushes real yields higher, which we know real yields and gold have a strong correlation, which inverse correlation, excuse me. So as real yields go higher, gold will go lower. And we went over this in a one of the podcasts in the last like month or two, where we took I think it was maybe 2 weeks ago. From I would go back 2 weeks from now or three and check one of those podcasts. We went over what the situation in real yields would have been back then. And if you look at gold's correlation to real yields, you could almost say that, well, you could infer back then, as the Fed was hiking rates, as the 10-year yield was ripping, as inflation was ripping, real yields remained negative because the inflation expectations never actually caught up to the rate of the excuse me, the inflation the nominal yields never actually caught up to inflation expectations because nominal yields are more anchored by the Fed, while inflation expectations have more of an anchoring towards the inflation expectations themselves, right? But we didn't have the inflation expectation component back then, so again, very hard to
Hmm.
track. So what we do is we look at gold, right? Gold rips dramatically during that time period. Now,
Yeah. So if
yeah,
if you know that tips, which didn't exist back then, are inversely correlated,
right, you would
then you
assume,
can kind of
yeah,
assume
that
what it would have been.
real yields would have been going negative. Now, there's a fundamental factor that's very hard to account for at that time, and it's the distrust of the dollar. Did people really think the dollar was going to be worthless, and they thought that no matter what real yields were doing, that they needed a core alternate to to the monetary system, which would have been gold? Again, that's all theory and speculation because now over the last 20 years or so, we have positive data. We have a large amount of data that shows that positively shows the correlation is inverted between gold and real yields. So obviously we're going to use that to our advantage, and we kind of leave the past to be the past. Older times, not as much technology, not as much market dynamic as there is today. So when you see this verbiage of 1970, oh, the Fed hiking interest rates is going to be good for gold, I don't really pay much attention to that. Pay attention to the now, and I wanted to pivot from this into bonds because this has been the gaping of the year.
Yeah, and it
Men,
just keeps going.
yeah, yeah.
It just keeps going.
Many people are sitting on softballs with this one this year because straight up, there is no love for this. I just remember earlier this month, right? So we're at August 25th now. So August 4th, right at the start of the month, everyone was saying that the lows and bonds are in, and bonds can go much higher. Are the lows and bonds in? Man, maybe. But I
Yeah,
doubt.
maybe, but like,
Again, how can you say that when a bearish trend? Because if I would have went back any time here, and I would have been like, man, listen, the lows might be in, right? And then sure enough, just
yeah.
same thing,
Well, like
right?
at the end of the day, man, like terminals keep rising.
I know,
Like every week, the terminals keep rising.
I know.
So
We're gonna go over that in a
that
bit too. We're gonna go over that whole
that's
dynamic.
key. As long as terminals rise, ZN's going to continue downward.
Yeah, and I think that the problem that people are running into is they see recession and they think buy bonds, and that has not worked at all this year.
Yeah.
And
This is a different situation. Recessions are deflationary. They're
right,
always deflationary. You look back, look at the dollar, it's very deflationary. This time it's different. We got the dollar essentially strengthening,
yeah, we're gonna go over that
deflationary,
too. Yeah,
but we've got bonds coming down because we're not in a deflationary environment. We're in an inflationary environment.
and
So
and we call that
that's what's confusing a lot of people, and
and
that's
we
stagflation.
yeah, Stagflation is called is it's we call it stagflation, but it's literally the inflationary recession.
Yep.
It's the recession that no one understands because unlike most recessions, it's inflationary. It's the odd lot out. Most of the time, the stagflationary environments lead right into deflation. But because of the severity behind the inflation components, we're getting a much more exacerbated stagflation, which is very similar to 1970, 1980, where we have basically runaway inflation and the Fed's chasing. And in that type of environment, things kind of break, meaning the negative stock bond correlation flips, right? Stocks and bonds are both now positively correlated. A lot of things go into a cycle where most people are not conditioned for this. This is not a frequent event. Odds are we're not going to see this for a while after this because inflation is not normally running away, right? It's normally under control. So this is an abnormality within itself. So the next time we see this might not be for many years. So this is kind of like the hump you got to get over, and we can get back to some directional savage plays. Until that happens, though, you don't want to risk blowing your load on something that's going to shit the bed, and
Yeah.
that's like
Until that
leverage
happens,
bonds. Yeah,
it's survival.
I know.
Survival of the fittest.
Yeah,
That's what we
straight
got to be
up.
doing.
Straight up. So let's go into the important recap of what happened so far this week, and then we're gonna go into a few topics talking about bonds and rates and the dollar. And I think that will round out this week pretty well and get us ready for the last week of the month next week, and especially next week. By the way, we have Friday. We have the unemployment rate coming out, so that's gonna be really interesting to see because. We know that the Fed is primarily looking at that number, and the way that they've always done it is, they're going to look at employment to maximize employment. So if they don't see employment really unemployment, right? They're going to maximize employment, which would be minimizing unemployment. So if they don't see unemployment start to pick up, it's almost like a green light to them, like, oh, we can just keep going because I know that they had verbiage about, oh, we need to see how what we do affects the market. But primarily, if it would be crazy if we see another new unemployment percentage low next week, because that would just basically be like a middle finger to the Fed in their minds. It's like,
Yeah.
oh my God.
It'd be like
yeah,
everything they've done so far has done nothing,
right.
essentially.
Right. So that's something we're going to watch out. But let's go over what happened this week. So we had the preliminary manufacturing PMI as of August come in with a miss at 51.3. The forecast was for 52, and the prior figure was for 52.2. So we came in below the forecast and below the prior figure on the prelim manufacturing. And then we had the prelim global S&P Global Composite PMI as of August come in with a miss of 45. The forecast was for 49, and the prior figure was for 47.7. So another print below both the forecast and the prior figure. Then we had the prelim services PMI as of August come in with a miss of 44.10. The forecast was for 49.2, and the prior figure was 47.3. So again, another print below both the forecast and the prior figure. So that's we had three misses in a row right there. And then we had the new home sales as of July come in with a miss at 511,000. The forecast was for 575,000, and the prior figure was 585,000. So as you can see, another miss below both the forecast and the prior figure. We also saw this figure come in a negative 12.65% month over month and negative 29.6% year over year. So definitely a slowdown there. But again, that's not really too much of a surprise because due to the excessive rise in interest rates, that's to be expected, right? New home sales are going to slow.
Yeah, so essentially house prices have to catch up with the interest rates.
Right. Then we had core durable goods orders month over month as of July come in with a beat at 30 basis points. The forecast was for 20 basis points, and the prior figure was 30 basis points. So we matched the prior figure and came in above the forecast by 10 basis points. And this has been hovering just above zero all year, so this is holding on by a thread. Obviously, seeing this go into negative territory is not what we want to see. Then we had durable goods orders month over month. So this is durable. This is not core. So this is excluding transports. And this month over month as of July came in with a beat at 30 basis points. The forecast, excuse me, came in with a miss at 0. The forecast was for 60 basis points, and the prior figure was for 200 basis points. So we had a prior figure of 200 basis points, forecast to slow down to 60, but we came in at 0. And this is really on the verge of negative territory here, and we've been for a while now, so this seems, again, to be holding on by a thread. Now, we also had pending home sales month over month as of July come in with a beat at negative 100 basis points. The forecast was for negative 400 basis points, and the prior figure was negative 890 basis points. So this bounced this week, obviously with a big surge to the upside from negative 890 basis points to negative 100 basis points. But this still remains negative, and it has been for pretty much most of the year. We had crude oil inventories for the prior week come in at a miss at negative 3.282 million barrels. The forecast was for negative 933,000 barrels, and the prior figure was negative 7.056 million barrels. So again, we saw a slight bounce here from last week's reading, but we still remain in negative territory, which is just reaffirming that the oil demand holds that bid. We also had preliminary GDP quarter over quarter as of Q2 come in with a beat. Again, it's going to sound weird, but a beat at negative 60 basis points. The forecast was for negative 80 basis points, and the prior figure was for negative 90 basis points. So obviously this is a good sign, right? So we're not missing estimates to the downside, but it's still negative, and we'll have to see how this progresses toward the final reading. But instead of coming in at negative 90 basis points or lower, we came in at negative 60 basis points. So it's still negative, but better than the prior reading. Then we had, this is real interesting, we had the preliminary GDP price index. So this is the price index of the GDP components, right? Come in quarter over quarter as of Q2, come in with a beat at 900 basis points. The forecast was for 870 basis points, and the prior figure was for 890 basis points. So this continues to show inflationary pressures remain dominant as this came in higher than both the prior number and the estimate. So that's something we have to pay attention to in the next CPI reading. And if you look at commodities themselves, they're actually rising. So let's see. Let's pull up commodities real quick before we go into the last few bullets here. So this was the July close at 2609 on DBC. We're above the July close now, which is quite interesting. So there could possibly be, as of right now, there is a little upside risk here in CPI. I mean, we were above July. Now I know CPI is year over year, right? So you have to compare from the price, the appreciation from the prior year, but obviously commodities going above their prior month's close is not something we want to see with the peak inflation, right? Inflation's peak, CPI's done. It's not something you want to see with commodities grinding higher, right? And that's just not good. I mean, I know CL's bearish trend, it has been for over a month now. And I mean, we called this, we said that, listen, we tried to buy the dip back then here, given if there was going to be a break higher. We got out right away. We said, listen, there's downside risk here. This is not something you want to hold right now. And obviously,
yeah, you're essentially fighting the Fed by longing commodities, but there is
upside
an opportunity there.
Right.
Like DBC going bullish trend, that's an opportunity right there. That's a long opportunity.
Yeah, and that wouldn't be too good if that happened, honestly. If DBC goes bullish trend, I'm talking about from the inflation fight perspective, right? The fight on inflation, that's not good. You don't want to see DBC go bullish trend, and that's something that we make note of because DBC is now at Momo. Meanwhile, crude is not. So this is basically telling you if crude is to rip to Momo, DBC going up. DBC is at Momo without crude, so that's something you got to be careful. And if crude really wants to put a stiff bid into here, it's not going to be good for DBC and commodities or CPI. I mean, it's going to be good.
And that doesn't take much. Crude could easily move from where it is right now to Momo in a day if it wants to.
Yeah, this thing can really rip. And what's crazy, it's been basing right around $90 a barrel. You have some
Yeah, it's not looking good.
yeah,
It's
it's not,
not looking good at all.
yeah, I mean, it's a bearish trend though, so we can get the Momo tap and a fade, right? Long story short, it's very hard. This is one component of this is the biggest commodity. Energy is the biggest component in commodity indexes, right? So it's something we watch, but the fact that commodities are already at Momo and chugging higher is not looking too hot. But
Well,
we'll
especially with the terminals that are priced
I
in,
know,
and you're
I know.
still seeing commodities go up. That
Yeah,
that's essentially telling you that
not enough.
that terminal is not enough.
I know.
That's not enough to stop
And we're
inflation.
gonna dive into that in a few minutes. But let's cover the rest of these economic points. So obviously, due to us recording this on Thursday, we're missing some really important releases coming out tomorrow. That tomorrow being Friday, being PCE, core PCE, trade balance, personal spending, and the Powell speech. So what we're gonna do is in our public Discord channel, you're gonna find a brief overview of the speech of Powell's speech tomorrow to come along with the podcast, so you can go back and basically catch up, or I guess go forward. Right, you can go forward to tomorrow and not miss. You won't miss anything because typically this podcast is recorded on the weekend, which would have covered this. So we want to make sure you guys get a rounded overview of the week, and to do that, we're gonna have to basically play catch up and provide that report later. But let's continue with the podcast here and let's go over the dollar because this has been quite interesting. Ever since the middle of the month, pretty much, or the first 2 weeks of the month, we've seen the dollar on a relentless bid. We had the
Yep.
dollar
Cash is king.
yeah, cash is king, baby. We had the dollar push the prior, not all-time high, but the prior yearly high multiple times, and we had these shallow pullbacks that keep getting bid up. Overlaid on this, you have the ANFCI, which is the Adjusted National Financial Conditions Index, and this is basically the market stress index. Anything above zero is considered to be more tighter than average. Anything below zero is considered to be looser than average. We were tighter than average for a couple of weeks, and then or maybe a couple of months? No, a couple of weeks, and then we pulled back and we have this shallow dip, but the shallow dip still remains extremely high compared to where we've been just historically. This dip is pretty much where the ANFCI peaked in 2016. So 2016, are we above 89? Yeah, we are above. So we're still above the peak of the 2016 bull dollar run. So this is quite interesting because this is basically telling us, the dollar is basically telling us that liquidity remains poor, and stress on the financial sector remains elevated as the demand for cash continues, because at the end of the day, this is the inflationary recession, right? Bonds are not the play and stocks are not the play. So where are you going to put your money into? And if you say Bitcoin, just Godspeed, because that's obviously not the place to be going, right?
Well, there's also the pressures of other countries. All
Yes,
their currencies are going in the shitter, so
yes,
all the more reason to buy the dollar.
the poor euro getting. You want to talk about it gaping? It's getting gaped.
Oh, jeez.
This looks worse than bonds.
Yeah.
Yeah,
Yeah,
terrible.
I like that. I like that tweet. It's called soccer now.
Yeah, yeah. Yeah, that's funny, right? I mean, straight up, like the dollar demand is relentless because when you have your own purchasing power get destroyed, gold isn't the play because rates are rising, right? And real yields are getting pushed higher. So
Yeah.
worldwide gold is. I mean, if you were to price gold in euros, it may be a different scenario, but you also take on volatility of a hybrid commodity and currency, right? Where you're taking less volatility within the dollar. Well, I mean, usually the dollar has less volatility, but this price action lately, I mean, this thing's on fire. So it's like, okay, might as well hold it, right? Because it's safer.
Yeah.
And
It's the best performing
yeah,
place to put your money right now.
I know, and that's crazy, right? Because nobody understands that. Oh, the dollar. Oh, I mean, it's just a buck.
Hmm.
Inflation. That's another thing. Inflation's ripping. Why do I want to hold cash? I was actually at my barber earlier this week, and he said he's got a bunch of money on the side, and he goes, "What am I going to do with it? Well, what should I do with it? Excuse me, because I have a huge. I see that we have this huge inflation going on, and I told him that, well, if you were to ever look at the value of a dollar in comparison to other countries, you'd be surprised that this inflation is actually nothing compared to what other countries are experiencing. Not the inflation of our goods, but the value of our dollars actually going up. And this has to do with inflation being so much worse around the globe that people want dollars, and access to dollars is just not. It's not. You're not able to. It's not. There's not enough supply for the demand, so obviously the price goes higher. That's what happens when the value of the dollar is going up. The demand for foreign currencies are dropping as the price drops, right? Or and inflationary metrics, people don't want to hold it and they swap to something else. And the quickest thing to swap to, a lot of these countries have swap lines right with the Fed, so they go right to dollars, right? Not to Bitcoin, not to gold, go to dollars, and that's simple and easy, easy swap. But let's continue. Let's talk about long-term yields, 30-year yields coming off the lows here, just as the dollar was earlier this month. Long-term yields are rising too. Long-term yields, this is the mortgage rate, 30 years, right? So if you were to think about, I mean, it's not the mortgage rate, right? But you get the point. This is going to be most correlated to the mortgage rate because it's a 30-year treasury, so mortgage rates are going to be off their lows, right? So if you came into August, you would say, oh, mortgage rates are off their highs, right? Or 30 years off their highs, so I can assume mortgage rates are off their highs as well. Okay, that's obviously no longer the case. 30-year moving higher, it's going to have upward pressure on mortgage rates, and we are being told that Biden's doing so well. And listen, I'm all for the guy. I hope his punch tastes good, and I hope he's killing it. But he is not he's not lining himself up the right way out here talking about I'm saving you guys X dollars off the highs. I think that's a very not I don't want to say misleading. I think it's a wrong thing for him to do because he's putting too much risk on the table for himself. For example, if 30 years are ripping like this, all it takes is crude to really accelerate. And then this whole savings scheme he's been playing gets thrown down the toilet. He should have taken a different approach. I mean,
Well, I mean that's what we want though. We want the 30-year. Like that's not what's good for him,
no.
obviously.
Yeah,
But we want the 30-year to surpass the inflation rate.
right. And that's something that we have spoken a lot about in the last couple of months. If I were to lay this over for you guys real quick, let's overlay the inflation rate. Sorry guys, can't spell today. All right, let's throw this on a weight chart. So, and let's put them on the same axis so you guys can see. All right, let's bring this out. So, historically, over time, the 30-year is on top of the rate of inflation, right? Over time, going back all the way to 1987 when the 30-year came out, or at least TradingView let us track it. So as you see, the 30-year is dominantly over, and whenever inflation gets up, it above that value, it usually drops, right? It goes back under. You can see the predicament we have here. I don't need to explain this to you. The white line is just greatly over. The distance is just huge between the white and the orange line. Something is going to happen here.
It's they need to converge.
Yeah. Now the problem is, this is the problem. The problem is if the 30-year really accelerates to 5 or 6%, and that would most likely be accompanied with an accelerating terminal rate. I mean, this is not going to accelerate without the terminal accelerating, and that's something that is not good for a lot of things, primarily risk assets and bonds. It's just something that adds to the stagflationary problems we have because the rates rising that much, okay, so just remember, inflationary regimes are risk on. Inflationary regimes, like from a regime perspective. That's when inflation is accelerating.
You need growth accompanied.
Yes, but it's only to a certain margin where growth and inflation, or specifically inflation rising, is actually bullish for the market. Because what we've seen inflation rise already, and the amount of inflation we have, if rates need to accelerate, especially longer term rates to 5-6%, that we're going to go back to a rate environment not seen in 22 years, right? If in the 5% range, we won't be back. We'll be back to where we were over 16 years ago. And that, you have to understand the amount of companies that don't make money and need to borrow money. You're talking about a lot of issues when long-term rates are up at that level. Am I telling you we're going to go there right now? No. My biggest thing has always been, I think they're going to converge somewhere in the middle. I hope that we don't have like an elongated recession, because quite honestly, this shit sucks, right? Like this whole
This
stagflation
is
regime
the
is
shittiest
yeah.
regime we've ever experienced.
Yeah, literally, literally. And I've been doing this a while. So for me to tell you this is the shittiest regime that I've experienced, there is definitely greener pastures ahead. Okay. So just, we got to get over this hump. Obviously, this can be a very strung out process because of the Fed. The Fed doesn't want to scare markets, and we basically know that they came out a couple of weeks ago and they in their last presser, and they said we're going to be data dependent, meeting by meeting. And our belief at the time, we made a podcast and this is timestamped. We said that the Fed is basically disconnecting their guidance and they're making the terminal placeholder that they can gradually move up without giving guidance. Mm-hmm. Right? And it prevents them from basically pushing the market lower. And actually what it did was it reversed the market up, because, the Fed's dovish now. Oh, well, it's good. Okay.
That's exactly what they wanted.
Yeah.
They got the cushion.
Yeah, they got the cushion now. And now we have Jackson Hole tomorrow. I'm really excited to see what comes out of this, what the verbiage looks like, and I'm going to report it to you guys. So this way you guys are well capped for Monday. But I said this from the beginning. I think that the terminal's a placeholder, and I'm not going to brag, but so far I've been right in the fact that the terminal has literally gone up week over week. Okay. Mm-hmm. We've been every podcast we've made, we've been raising that terminal rate on the sheet, on the chart that we have when we go over the effective federal funds rate. I mean, if we look at it right now, let's see, effective federal funds rate. Let's see if we have it on here. 3.72. Okay. What is it right now?
I think it's higher. 3.8.
Yep. And 3.86. It's another raise. Okay. This
every week.
Every week. And I'm going to explain some details about the terminal in a second here. We're going to go over that quickly, and that's where we're going to wrap up the podcast. So for those that don't know, the terminal is the rate at which the Fed expects to stop their policy action. If it's rate hikes, it's the peak rate. And if it's rate cuts, it's the trough at which the Fed will stop and hold rates at. Unfortunately, the trough has been zero. So when you talk about rate cuts, the terminal is zero, right? Because they just cut to oblivion, and they just cut till they can't cut anymore. Rate hikes are a bit different. We're at the point where the next rate hike will push us above the 2019 peak. And right now that's being priced at a 67.6% chance of 75 basis points as of the recording. And we won't get that till sometime in September 21st. We'll see what they do. But as of right now, that's pricing at a 67.6% chance of 3 rate hikes or 75 basis points.
As we see commodities rise, we can expect that chance to increase as well.
Yes, exactly. Because those are inflation expectations, right? Commodities are a part of CPI. So if they are rising, what you're seeing with DBC, it's just more confirmation towards the fact that rates are going to be hiked to what they're being indicated at. Another big update this week. We're starting to see the July rate hike expectations or rate hike / cut expectations come back to life. This was much lower. This was at one point pricing in
0.9, negative 0.9.
Yeah, at one point it was negative 90% chance of one rate cut. That's very interesting. So what that's basically telling you is that the market is starting to pick up. This is going to keep, because this can change again, right? We can see Jackson Hole and change some things. Maybe the next jobs report next Friday changes something, right? Or maybe the CPI report in September really shifts something. But as of right now, they're pricing in that rates need to actually go up and stay higher for longer. We are seeing the March odds of the March meeting odds actually pricing in an 86.4% chance of a rate hike. So now we have one almost 100% chance of one rate hike in March. We're almost at 100% chance now if 2023 is going to entail the first meeting with one rate hike. And a good way to look at this back end of the curve, because this, number one, this is more liquid, right? The further you got in time on futures contracts, the less liquidity there is. So just in general, less liquid, right? So let's go back. Let's go forward in time, and let's look at the that specific futures contract. So the July contract, which is this. Okay, let's turn off DDAP just so we can get a clean look at this. And this is shown inversely. So this is the Fed funds futures for that July 2023 meeting or month, right? And then the meeting, you have to use some math to basically reverse calculate what that average rate's going to be, which we have that built in on the website. But for the sake of the discussion here, a simple way to look at this is just to take the meeting you're looking at and invert the chart.
Yeah.
And think of this as rate hike expectations.
Yeah.
So
as it goes down now, it's rate cuts. As it goes up,
rate
hikes.
Right. So now as
when
we
it's inverted.
Yeah, exactly.
Yeah,
so
when it's inverted.
We came off of June when the market was really heavy, and then we pull the rate hike environment was really strong, right? Oh, we're gonna hike, and we pulled back. And just as in July, end of July, we actually put a bottom in. We've been going up ever since, slowly grinding. If this takes out this high here, we're gonna have problems. Specifically in long-term yields, I think they're going to break out. Like the 30-year we were just talking about, I think bonds easily put in a new low when that happens.
Yeah. 2-year and 10 is probably going to invert even further if that happens as well.
I mean, the 2s and 10s are currently sitting at negative 34 basis points, but if that happens, it's just not good. Not good all around. Really isn't. For the environment, for risk assets in general, because the Fed is going to be seen as being more restrictive for longer. And
this is why we're taking those inflation expectations in our regime model, the risk on expectations, we're taking that with a grain of salt.
Right.
That could very well, that is for sure caused by this bear market rally. But when you look at the underlying, as we're doing now, talking about the EFFR, all that, it's really not a risk-on environment behind the scenes.
So let's just take, for example, so the Fed basically came out here on the 19th, I believe their meeting was, right? And the market ripped, or was it the 27th? It was the 27th. I'm sorry. So let's look at where we were in the earliest part here, the 22nd. Okay, the 22nd, the combined risk-on probability was less than 25%. Now we're above 31%. Excuse me, no, 41%, right?
Yeah.
We're above 41%. We were below 25% less than a month ago. And I'm thinking, because again, I know it's very important you guys pay attention when I talk about the model, because I know how the inner workings of the model work because I built it, right? So I know the features of it. So I know how this works, and I can tell you that the rally in risk assets is playing a significant role at this point in time in the rise of the risk-on probabilities. So when I see the market pick up in risk-on pricing, I'm like, oh, wow, maybe we get a risk-on pivot. But I don't hold much weight in it, which is why I still lean rather bearish, because the system's bearish, the market's bearish, overall environment's still bearish. But I have to still, you have to still appreciate that, listen, man, maybe this could be a risk-on pivot. But regardless, I know that a lot of that juice that's being priced into the risk-on regime is because we could do the math here. Let's go from the lows. Let's go from the lows to where we are right now. Within 70 days, so a little over 2 months, the market's 15% off the lows. Right?
And that goes with everything, essentially every asset class. And when you look at the inflationary performers, most are all green. Most are all outperformance of the SPY. So when you get a rally like this where everything is outperforming, it's going to weigh heavily on the inflationary regime.
Exactly. And that's going to just really affect it's going to cloud a lot of people's judgment. And I think that I want to leave this podcast off with take regimes as they come, step by step. Don't sit here and try and get the risk on pivot. Worry about the risk on pivot. There's a lot of people that overthink this, and I don't want anyone to overthink this because it's not to be overthinked. It's very simple, right? That's what the system is designed for. The system is designed for us, for it to do the thinking and us to do the doing. The system does all the thinking for us, right? It's telling us all these metrics. It's telling us what's going on. System strength has faded significantly, but again, look where we were a month ago, 92.92%. We're at 33 right now. Again, another major component of the short spurt in risk assets to the upside. So you have to take that with a grain of salt. But regardless, the system is telling us risk off. We have to take that and say, listen, no FOMO, no bull trats, none of this bullshit. We're taking it step by step. The ES is telling us, listen, market's still overall bearish. Bonds are bearish. We have to say there's no real place to put money right now. Be broad-based short because the fact that we're in a risk-off environment, probability is always higher that market goes lower, right? Risk-on probability is always higher that market goes higher. So probability is higher, market's lower. So we want to have a broad-based allocation to be short things that will move to the downside, but not too much to where if we squeeze, we can get really hammered. That's why we're not short Russell. That's why we're not short some of these things, because the bear market rallies, right? If we go from the lows here, the bear market rallies are, much more. We're at 20%. We were at 15% on ES, and it's also just not something that we'd rather allocate to ES. Get a broad-based equity short, right? One of the biggest index literally is defined as the market. Most people define it. And then we get subsector shorts like semis and high beta, and those are weighed a lot less because, again, those are more volatile. So we'll hold them. Higher probability market goes lower. That's what we're going to do. And if that changes and turns into a higher probability of market going higher, then we have to adjust accordingly. And I think that's where we're going to leave this week off. We'll drop that message along. You can find it in the pit after this is released on YouTube. You can go to the pit, or in Spotify, you can go to the pit and just catch up on the Powell presser from Jackson Hole. Get a little, or during Jackson Hole, you can get a little bit of an overview of what's going on with that situation, and you can get yourself ready for the week ahead next week. I thank everyone for listening. I hope you guys enjoyed this. If you have any questions, go to our website at www.market-radar.com. And you can find access to join our Discord there. It's free. You can go and find us on Twitter at The Market Radar. And you can find us on YouTube at The Market Radar as well. Thank you so much for listening, guys, and have a great week.